macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
Welcome back to Cook's Kitchen. Very excited to be back here in the new Zach's state-of-the-art studio. Let's get right to some charts I had to show you. First up, S&P 500. This is from last night's close, so you're seeing 1998 here. We're now below, or 1988, we're below 1990. And this, this market is doing a classic rollover thing here. It's done many times before. And we could get a pullback here in 1960, 1970. That's what we've been watching for. I threw some Fibonacci's up here from the April low, and a 38% retracement would get you all the way to 1935. I don't think we get that far because I think buyers are going to be stacked up 1950 to 1970. You got the 50-day moving average there. A lot of other support, and so I think buyers will come quick. Next, let's go to treasuries. This is TNX, the 10-year yield, and this morning we're above 2.5%. Now this is a 5-year weekly chart, and obviously this is the big factor you want to look at. I mean, what's the biggest thing that could impact the stock market right now? It's not the Ukraine. It's interest rates. When are they going to rise? What is the Fed's stance? How long will they be dovish? And we've got a big FOMC meeting next week. It's the big quarterly quant fest where you're going to get new economic projections and a press conference from the chair. So I think that treasuries here are selling off, interest rates moving higher, sort of in anticipation, apprehension even, that there could be a hawkish shift from the Fed. I don't think so. So I think that the 10-year yield is still going to flip around 2.5% here, and we're making a play on longer rates rising eventually, but they're not in a hurry right now. All right, let's look at another interest rate play here. GLD, gold. This is one I've been bearish on gold. Have always wanted to be short this thing, and I missed my last chance here over the summer. Wasn't paying attention to it, and we use DZZ to get short gold here. Now we're back into this support level. I'm just not a fan of buying it at this double bottom, although you'll probably get a bounce. I would still be short gold. All right, next let's look at another interest rate sensitive trade that has been really working for us finally now, the yen. This is being short yen, double short with YCS. And we got long in April and just stuck with it here around 65, 66 and just let it sit, and finally, woof, this thing is taken off. This morning, I think it's above, YCS is above 72. So we're making some coin there, and this is equivalent, like down here this is 65, 66 and YCS is like 100 in dollar yen. Now we're up here above 106 in dollar yen, and that will continue with easy monetary policies from the Bank of Japan. And you look at the euro falling apart too. All right, next we are going to talk about some of my beliefs about this bull market, big picture beliefs. I'm actually going to show you some bullet points from my last video, which was in March before we moved. These are bigger picture themes that I believe in, and we'll see which ones are evolving, coming true, that sort of thing. So first up, that I think the secular bear market is over. Breaking through S&P 1600 was a big deal, and barring a recession, S&P 1600 will be strong support. All right, also in March, I said the S&P is going to 2,000 this year. There we go. And probably 2,500 in the next 2 years. Now, you've just had a bunch of big strategists from Wall Street come out and talk about they're getting more bullish. We just had the Barron's piece. Stephen Auth from Federated 2 weeks ago said S&P 2,500 the next 2 years. Cook said it back in March. These guys are smarter than me and have more money at risk and more responsibility, but this is the big picture. They're looking at the same things. What is the economy doing? What are earnings doing that would justify continuing to accumulate equities? And this is what's going on here. All right, next up, 10% correction. Hey, we could use one. It would certainly cleanse things and fuel the gas tank a little bit. Here's the deal. Everybody looking at this market rolling over this week, maybe ahead of the Fed, the bears are almost have almost given up thinking that this is the big correction, the big crash. And you've got, and this is why I say that there'll be plenty of bids lined up at S&P 1950 and 60, I believe, for people who don't want to miss the bull train. You know, they're underinvested, and that's why these dips get bought so quickly. Back in August, one of our key indicators for looking to buy that dip was the percentage of stocks under their 50-day moving average. In the S&P, that moved to under 30%, and that was a big oversold buy signal for us. Next week, we'll look at more breadth indicators. Back to my bull market beliefs in a strengthening cycle, you can't forget emerging markets. These are some stats from Artisan Partners up in Milwaukee, and they really like to focus on emerging markets. And studies that they put together with some OECD stats are that middle-class spending will rise to $35 trillion in just another 5-6 years here, and to $56 trillion in 2030. This is a big deal. Emerging markets are still a major economic engine of the global economy, especially with 45% of S&P profits coming from abroad. And Europe, still kind of back on its heels. Emerging markets are where it's at. They are integral to our own S&P 500. All right, the last thing I want to talk about, let's deal with this correction issue again one more time. Everybody talks about the fact that the S&P 500 has rallied 200% since the Great Recession lows, March of '09. How can it go on? This market it's a bubble, 200%. This is crazy in 5 years. And I say you're looking at it all wrong. What you want to look at is how overdone the market was in 2008 and 2009. Should it have ever gone below S&P 800 on the S&P? I say no. I think that was just obliteration of stocks, and it made no sense because the perception was our economy's fallen off the cliff, and you can't own equities. So what I say is, hey, let's look at it this way. Maybe 1,000 was where the S&P should have gone. Where are we from S&P 1,000? We're only up 100%, not 200%. And your big test was 2011 when we had that 19.5% correction, really challenging, the European fears and Washington fiscal fears. And so I really look at the bull market as still being very young and really only having rallied 100%. So we don't have this burden of guilt. We don't owe the market gods anything. All right, so bull market is still on. Look for a good dip to buy here. 1950 is going to be a good bounce. Maybe we go back to 1900. Who knows? Let's see what happens with the Fed next week and which way the bond market decides to take things. All right, I'm Kevin Cook. Thanks for joining me in Cook's Kitchen.